Welcome back in YouTube. So today we're going to talk about Paramount Pictures as they just reported earnings and well, it's not looking too pretty. Now, this is a company I personally like and I think that there's some value here and I think it's definitely undervalued, underappreciated by the street. It's not the most popular of streaming companies, but it does have a brand that I think is very recognizable. It's been around for an extended period of time and has a pretty extensive library of content. I think this is more of an acquisition for a lot of different companies. I could see a company like Disney possibly looking to bid on them, or even a Netflix possibly looking to bid on them as well. They have the ability to go to theater, capture capital there, and they're working on the direct to consumer with a recent partnership with Walmart. So there's a lot of things that are going on with Paramount that's going to take some time. And I've talked about this as I've covered Paramount Pictures and gave a price target of Paramount roughly around that $24 mark. Now, I did state that there's going to be some headaches along the way, and I think you can get it cheaper than this. And boy, is that the case. When we think about what Paramount trades for compared to its peers, it's extremely cheap, and maybe it's cheap for a reason here. But it's down almost 50% on the year, does pay almost a 5% dividend. Now, I don't know if they're going to slash this dividend, but we're going to take a look at the earnings and kind of come up with our own thesis and our own price target once again, as they did have a miss on both top and bottom line. And I feel if they did hit both top and bottom line, we'd be looking at an over $20 stock, which would be exactly where I had it before. So it's really important just to keep updating your analysis to stay ahead of price action. Once again, ladies and gentlemen, you can literally go down any sort of measurement you want as far as valuation goes. And you can see here that it's extremely cheap. Even on the trailing 12 month, it really sticks out that it's trading at a 4 PE ratio while the peers are trading at a 16 plus PE ratio. Now, you don't always want to go off of PE ratios, but it's definitely a good starting point. Now, if we go over to tipranks.com, and by the way, get yourself 10% off of TipRanks. Link in the description. Unbelievable platform if you want to know what the insiders are doing, what professional money is doing, and just price target. But we can see here that there's been an insider buy about 2 months ago of almost $900,000, sitting at $866,000 of an insider buy 2 months ago. So the management obviously believes in the direction of the company, and I don't think that's changing, especially with the partnerships and the strategy that Paramount is taking. Ad revenue seems to be the hit that they're taking, which is no surprise, as we saw Google take an ad revenue hit. We saw Facebook take an ad revenue hit. All these companies are taking ad revenue hits, and this to me looks like a buying opportunity, but we're going to dig in a little bit deeper. We get an average of a hold position, so it's not a strong buy right now, but I think after these earnings, we could see that shift. Price targets anywhere from $13 all the way up to $36. So pretty contrast opinions when it comes to Paramount. This is a promotional piece. Anytime you see the press release, this is going to be kind of more promotional stuff, but we're still going to go through it, as I think there's some interesting points here, as Paramount added 4.6 million subscribers and grew revenue 95%. So even though they missed on top and bottom line, we can see that there's definitely revenue growth with the company. They're heading in a positive direction. Even when we talk about what is going on economically, they're still growing. So we see here that advertising revenue declined 2%, but we have top line where they're promoting that affiliate and subscription and theatrical revenue strength drove 5%. So while yes, they did miss on ad revenue, it wasn't that bad of a miss here. It was like about a 10% miss. So when we look at revenue coming down roughly 5%, let's take a look at this really quick. Advertisement came down 3%. Affiliate and subscription came down 5%. So while affiliate and subscription was growing, the revenue came down. So that probably means that they're price cutting and trying to compete. That's what I would gather from that. Licensing came down 9%. That's a pretty substantial hit. And then we have expenses creeping up roughly 3%, which in my opinion is not too bad at all. So when we bring it down to the bottom line here of negative 11% operating income before depreciation and amortization, It's a substantial hit. It's 11% is a substantial hit overall. So they are growing. They're getting more users on their platform. They're growing subscriber base, which to me is probably more important than the 11% decline. I think the scalability for a company like Paramount is probably more important in the longer term than 11% short-term hit. But who knows? We could be heading into a recession. This could be a little bit more serious than I'm giving credit for. When we take a step back and look at it from a year-over-year, revenue did grow 48% and adjusted operating income before depreciation amortization increased by 65 million. So good numbers there. When we're looking more of the 6 to 9 months, it's been kind of trending in the wrong direction. When we look over the last year, it's heading in the right direction, and a lot of that is contributed to Top Gun Maverick, right? We all know that was a blockbuster, and they're cashing in on that. Paramount has the ability to kind of hit these home runs throughout the year that people are not banking on, and really gives the company a tremendous amount of upside and or downside depending on what kind of movies are blowing up and what kind of movies are flopping. But with that being said, the movies that blow up, they're able to put in their content library down the road and grow subscriber growth. So I really do like this business model, and I think overall, I think the valuation is still fairly low on this company, but we're going to still run the numbers just to make sure. And we see a little bit of shares added to the market, roughly 3 million shares added to the market, with net earnings coming in around 33 cents a share. And one thing I'm seeing here is cash and cash equivalents have come down a significant amount, coming down from 6.2 billion down to 3.3 billion. But we could see that long-term debt has come down as well. So they could have been paying off debt with that. It's almost a $2 billion difference if we factor in that they lost roughly 3 billion on cash reserves and 2 billion went to long-term debt. That's not a bad thing here, cleaning up the balance sheet a little bit. So want to see this debt get under control, but I don't think it's anything too alarming, especially when we factor in that a lot of these streaming companies tend to carry a significant amount of debt. Overall, while they're getting people on the wheel, it looks like they're taking an initial hit to get more and more subscribers. It really comes down to the execution of how they're going to get back to cash flow positive and paying down the debt. So while this is a cheap stock, it's cheap for a reason, as we can see through the balance sheet here. Guys, basically what I'm doing is I'm using very slow revenue growth rates. And the reason why is every year they're not going to have a Top Gun type of hit. So therefore, I'm being very cautious, saying they're going to do about 5% for the next 3 years, 3% for the next 3 to 6 years, and 2% from 6 through 10 as far as revenue growth goes. EBITDA margins right now seem to be a massive problem, but when we go back in history and look over Paramount's EBITDA margins, they tend to be all over the place once again due to spending on films and then cutting back on spending. So really hard to gauge. This is not a linear move up with Paramount. It's kind of ups and downs, pretty deep ups and downs, but it tends to trend in an upward direction when it comes to revenue. Definitely a lot of question marks when it comes to spending, and are they going to be able to recapture anything with new films coming out? I think the partnership with Walmart's going to help. That's definitely getting people on the wheel, it looks like, but it's also coming at a cost. So there's definitely a lot of gray areas when it comes to Paramount Pictures, requiring a 12% rate of return, factoring in that they are paying almost a 5% dividend. So annualized, that's going to be close to a 17% return, depending on where you enter in the stock price and if they can hold on to the dividend. Now, right now, guys, I would say the dividend could be a little bit concerning with the amount of debt that they have, with the amount of spending and the lack of free cash flow coming in over the last 9 months. I would say that I would not be surprised if the dividend gets cut and or just gets completely out of the equation, which I would think could benefit the company longer term and use that money to up with competition. With that being said, still a 12% rate of return. We're looking at a price target between $15.37 and $17. So I'm going to give a price target of $16.50 to $17 on Paramount Pictures. I definitely think there's a lot of risk with this company, but I also believe there's a lot of reward with this company, as if they come out with a couple hits in 1 year, we could absolutely see massive free cash flow, reinvestment back in the business, and depending on how strong the direct-to-consumer margins can grow, that is also kind of a question mark as well. So a lot of question marks with this company. I would say, be very cautious with this one, as it's in a transition period going direct to consumer, and it has massive ups and downs due to box office sales. As always, guys, appreciate your time. Thank you so much for spending it with me, and we will see you next time, investors. Peace.